Hello and welcome to an exclusive next level webinar. The title, Achieving Liquidity from Illiquidity, How to Exit a Real Estate Limited Partnership, a topic that we definitely have not even scratched the surface on, I think, on next level webinars yet today. So really looking forward to this one. I'm your host, Adam Carswell, joined by my co-hosts today, Mo Bina and Shah Ahsan, and we are joined by Simen, Ruge, and Jackson Stith of Syndicate Capital. The way we are going to do the presentation today, we actually have a series of questions from Mo and Shah that are going to help us really go deep into this sector as far as, maybe they could be considered FAQs. I don't know. I'm sure Simen and Jackson, you guys get a lot of the same questions. We'll find out. But without further ado, I do actually want to hand the microphone over to Mo and Shah. I guess, Shah, if you kind of want to cap things off here and begin your, your back and forth dialogue with Simen and Jackson. Really looking forward to it. The microphone is yours.
Thank you, Adam. So Simen and Jackson, you guys described, a little bit about yourselves and what prompted you to start Syndicate Capital. Traditionally speaking, like if you were, let's say, a limited partner and a general partner seeking a liquidity event, what were your options?
Well, it's kind of like Jackson's story, right? So maybe you want to go on and elaborate a little bit on the history of this, Jackson.
Yeah, so I think what I'll do is I'll address the LP and then I'll let Simen chime in for the GP recapitalizations, right? So a limited partner in almost, every deal is different. It's all papered differently, but let's just say the vanilla textbook example is a limited partner is a limited partner. They're a passive investor. And they, unless there's, fraud or some other major event, trigger in the partnership documents, they really don't have any rights to affect any changes to the operating business, to the business, right? So, and in addition, in most of these partnership documentations, they don't have the right to sell their position to another third party without the general partner giving their approval, because these are all private deals. They don't want just anybody coming into the deal. They could be disruptive, so on and so forth. So it's limited, right? It always has been very limited because of illiquidity, lack of marketability, and these legal mechanisms within the partnership documents. So a lot of times, just like in my case, you go back to the general partner and you say, I need liquidity. Such and such happened in my life. I need cash. I got $1 million with you. What can you do for me? And most general partners are in the business of doing deals and spreading their capital as thinly as possible across many deals so they can get the fees and they can generate the higher returns on that capital and so on and so forth. They often buying a limited partner back often is not, their primary desire in life. They want to go on and do other deals. So they typically offer some sort of discount, and a pretty deep discount. We've heard horror stories from people where they're getting offered 40 cents on the dollar, and there's nothing wrong with the deal. It's just a matter of leverage, and it's a matter of not having other options. So for the vast majority, syndication's really been around for about 100 years now. For the vast majority of that time, people were either selling back to the general partner or other limited partners. Now there are recapitalizations that happen when you're rejiggering the entire capital stack, sometimes maybe finance out or the GP refinances and they've held it for 10 years. So there's so much value that they can then buy the LP or all the LPs or one of the LP or whoever wants out the deal out with those refinance proceeds. But, it's really been internal, right? And so what we've really tried to do and are doing is creating a second alternative to that very private, very internal, insular world where these positions get traded back and forth inside of that LLC. And I think we're creating some real success and some real traction doing that. It's given people an alternative, and now they're realizing, it's a psychology change as well. Like I said, it's been 100 years where a syndication is syndication is syndication. Everybody thinks you get in, you can't get out until the GP says so. Well, some GPs just want happy partners in their deals, right? They don't necessarily want to use their leverage or their control rights or any of that. They might want that LP to recycle the capital into another deal that he's doing. right? And he wants to have a good track record and a good reputation out there in the market, right? So there's plenty of GPs that are like, look, as long as whoever is coming in, is a good guy, isn't going to be disruptive. I do my background checks. I make sure that, he's not coming in here to cause me trouble. Then let's talk, right? So I think that covers the LP. I'll let Simen speak to the general.
Look, I mean, there's a big caveat to all of this, right? You talk about the history of, are there other intermediaries to do this? And there's the big caveat is obviously, if you own 10% of a Manhattan office building, there are people that will help you do this. And there's always been, they're called investment banks, right? Once you get to a certain level or there are boutique shops that focus on the bigger tickets. There are funds that will buy them directly from you, but they need 20, 30, 40, $50 million tickets in order to be interesting for them, right? So for the vast majority of what we call the middle market, this function was more informal. It was usually with the GP itself. Or some informality through your network. You might have known a guy who was looking for that kind of position, and with a friendly GP, you managed to affect the transaction. But predominantly when we speak about all of this in the middle market, there were some niche players, but most of it is very informal. And then when it comes to the GP side of this, I guess this is, both in the bigger scale of things and in the middle market, this is a newer part of it, in that as a GP, you might find yourself with legacy equity. As you've done projects for 20 years, you're sitting with positions that potentially have a lot more value than what you put into them. And then comes the pressure to do more business. And as you probably, as everyone knows, in a stressed market is when you find the best opportunities, but then financing might not be the best, right? So it's a little bit of the catch-22 of the best opportunities come along when your availability of financing is probably the worst, right? So here's another way of accessing some of that legacy capital by drawing that down and selling some of it off. So that's a different part of the business as well.
And for those that may not be familiar with kind of like the phrase of like middle market, like, can you just give like a brief overview of kind of what you mean in terms of like the size of middle market and how it kind of pertains and relates to commercial real estate specifically?
Sure, I'll handle that one. So, we consider middle market any piece of real estate that is $100 million of value or less, right? Maybe in bigger markets like LA, or more expensive markets, LA or New York, Boston, Chicago, that valuation might go up a little bit, right? But in general, $100 million or less. This is, garden style apartment complexes, 300 units in Patterson, New Jersey. A retail strip center with a Hobby Lobby anchor in, Hialeah, Florida. A Motel 8 on the side of the road and, outside on the outskirts of Philadelphia, Pennsylvania. This sort of thing. We're not to, as Simen alluded to, if you have a, $750 million tower on Madison Avenue in Manhattan, and you own $100 million of that in equity, you're probably just turning around to your investment bank and asking for help in that. But if you have $10 million in a garden style apartment in Hialeah, Florida, they're not going to pick up the phone call. We will pick up the phone call because that's the market we deal in, right? So the ticket sizes we see are typically, 5, 10, 15, sometimes up to $25 million. We've seen things on multiple tranches of transactions up to $65, $70 million. The lowest we've ever seen is probably $800,000. But those are few and far between, it's the real sweet spot in the market seems to be the $10, $15 million ticket size. And that's straight equity ticket size, right?
So when we're talking about a liquidity potentially for an LP, we'd be talking about, of course, we'd be talking about a fraction of that, let's say $10 million or so. In terms
no,
of
that's an LP position. I mean, look, they all range, right? It just depends on how the deal was capitalized at the outset, because maybe the minimum was $250,000 and maybe the minimum was $1 million. Right. So the minimum investment when they put the deal together, that is. So I'm just saying the market that we seem to be dealing with, right? And like, if someone has a $500,000 position, we'll talk to them and see if we can move it for them, right? But what comes to us seems to be $10 to $15 million, maybe, kind of in that range, and that's squarely middle market real estate. That's one or two LPs in a garden style apartment in, like I said, Patterson, New Jersey, or whatever the case may be. Just a couple of wealthy individuals or that put money into this deal with a real estate developer that they knew, and now they need a shift out of it for various reasons, and they come to us. I hope that answers your question.
Yeah, thank you.
Thank you. And so Jackson and Simen, when when people, or one of the misconceptions people have about a limited partner wanting to exit a deal is that they just assume that it's distress, but that's not always the case. And Mo kind of touched upon this earlier, but in your experience, what are some of the common reasons why an investor may want to, let's say, exit a deal?
Well, maybe I'll take this then. I think a common denominator is time. The time horizon of a deal is always the big problem. So it could be anything from the fact that when they went into the deal had a 5-year horizon, and at the 5-year horizon they were supposed to get their money out, but then someone decided to prolong it. So it could be as simple as that the majority, let's say you find yourself in a deal as a minority LP investor, and the other investor in that deal is a pension fund, and the deal is running very well, and the pension fund is close with the GP and says, look, we'd quite like to keep this thing running, and the GP says, well, there's nothing in the document stopping you from doing that, and you find yourself in a ride that's a little bit longer than what you want to do. So that's one. A lot of the time it's a personal event, let's say death, divorce, these kind of things, where there might be a change of ownership. Whoever inherits the LP interest doesn't want to hold on to it, has a different need. You might have a different need for cash in your life. I mean, people at some point have to pay for the kids to go to college. You might want to buy that house in Florida you've been dreaming about. There are a lot of different reasons. I think the common denominator is that when you make investments for a really long time, even if you really, really try to estimate what your life is going to look like in 10 years, it's hard to be exact about it. And stuff happens. So that's kind of one of them. And then there might be just a simple rebalancing. Like, in the last, during this pandemic, there's been a big shift in preferences around what people like in the real estate spectrum. Like retail is not a big hit at the moment. Office space, there's been some big questions around. So like if you're an investor and you're sitting on a lot of office space, maybe you're looking to rotate out of something like that. Maybe you could find an investor that has a different view on that. In some of these contested areas, there might be some difference of opinion on what constitutes a good deal, and you might be able to, exit in a sector of the market you have less belief in and go into a new one you believe in more, or something like that. So there's both this kind of life event side of it, and there's a reallocation side of it, which I think is interesting.
Right.
So if I could add to that,
Go ahead.
that extends to general partnership recapitalizations, right? Just to speak a little bit on a deal that we are onboarding, in the process of onboarding, partner, and this general partner put several deals together with the same group of limited partners, and the limited partners basically said to him, sure, we'll invest with you as long as you put a tranche of preferred equity in here. Well, preferred equity is expensive, right? And so they came on board contingent upon that. He was never that comfortable with it. So now he wants to clean up his capital stack. They like in the case that I described about myself earlier, they've made some money on paper. He has this piece of preferred that's ticking over at 12 or 13% interest, whatever it is. And some LPs that would not want to be in the deal any longer if that piece of preferred goes out the door, because then their IRRs, their cash on cash comes down. That's how they're juicing their returns, right? It's on their common equity. So, going back to what Simen was talking about, it's also a rebalancing of the capital stack in some cases where, look, we're just going to bring in one big LP. We're going to take out this preferred chuck. We're going to take out these LPs who require this preferred equity in the capital stack. We're going to clean it up. I'm getting a nice clean capital stack with one LP that doesn't have that requirement, right? So that's also a case where these kind of transactions transpire.
You guys have touched upon this already a little bit, but in terms of the quite a bit of the deals that you see coming your way are liquidity events, on the GP side. So what are some other reasons perhaps that maybe a GP or one or more GPs may want to exit out of a deal? Simen did mention about changing in perspectives, perhaps, especially like with office and retail going through some transformation right now. Perhaps, there could be life events and perhaps perspectives and other things that change, someone's position in these deals because they're so long-term and, multi-year hold periods. But what are some other reasons why a GP may want to exit out?
Yeah, I think there are a couple of different things there, right? So we can kind of class them into two things. One being GP-led deals, which involves LP capital in the deals they have, where they're in the driving seat and they're kind of replacing one investor for the other. So that's one where we're working for a GP to do something about the LP capital. When it comes to the GPs themselves, it's going to be very difficult for an LP to cleanly exit the deal and leave their LPs inside. I mean, it's a bit like abandoning people on an island, right? So it's probably not going to work that well. But a lot of these, a lot of legacy deals that run for a while have quite punchy, have done well. There's some excess equity there. You might be in a position where you can bring in more LP investors. You might be able to take some of your own chips off the table. And, a lot of the times, this is also something that's interesting in how a project comes together. Like there are different stages to development. Like I'm telling you guys stuff already, but like you start off with a piece of land, you build a building, you stabilize the building, and then all those phases are different. And through all those stages of development, there's a different risk profile, right? So let's say you bought a piece of land and you want some investors in to help you build a building. That's a very different risk perspective than say, I want to buy a building that has tenants that's paying an income at the moment. Those are two different classes of investors. The group that likes the construction and development side of it is not going to want to sit and earn income for 10 years. So you might have these kind of handover periods where you say either the GP has footed the bill himself, developed the building, and now stabilize the building. And they can take some chips off the table both through a refinancing, but it can also get some other investors who just want to hold this for a very long time. That's one way of looking at it. And then you can also, you can essentially tap into a different type of investor base and recycle the deal a little bit. So these are interesting things you can start to look at and do, right? And kind of, play more to the investor preferences rather than believe that you're going to sit with one set of an investor base through the entire life of the deal, or that you have to sell the building after development, after stabilization. You could just tweak the investor base and that way hold on to the deal. So there are many different things. Jackson, did I miss anything here? Sorry, I mean,
you didn't miss anything. Just to go back to the refinancing, right? That's not always an option for a couple of different reasons. Maybe you already have really good debt on it and you're not willing to try to do that, right? Like maybe you have really low interest debt with really long amortization with a bank that you like and you trust, and like you just don't want to refinance. So another way to tap some money that some equity that's been built, right? Hopefully you're creating value if you're a real estate guy, is to recycle some of that equity that you've built up over the past whatever it was, 3 years since you bought it and did work and upped rents and so on and so forth. Maybe you don't want to refinance because you like the loan you have in place, but there's a chunk of money there that you can get some liquidity for. And so this is a mechanism to do that.
That's a great point. Yeah, if I'm a GP and I've got a 75-25 split and I've added a lot of value and I want to still maybe stay in the deal, but I want to maybe cash out a little bit of the value that I've created, for myself and for the LPs, then this would be a great opportunity to take advantage of that then. So
call us, Mo.
Of course.
It's really interesting you guys brought up the example of debt, because I was also thinking about deals where there's probably prepayment penalties involved, and it may not make sense for you to go with the refinance, but you may want some liquidity. And that's where you guys can come in and, act as intermediary, for investors, both limited partners and general partners seeking to, take out equity, but without necessarily having to, go the whole process of refinancing, or maybe even incur prepayment penalties, which could, drastically affect the risk profile as well. So just to shift gears a little bit, let's just say I'm an investor. Let's say I'm a limited partner and I've invested $1 million into a deal and now I want out. What would that process typically look like if I was to call you guys and ask you about, what are my options?
Simen, you want to handle that? You're good with the process stuff.
Yeah, sure. I mean, I think a starting point is understand what you own, right? That's always where we start off. Have a conversation of, what's your situation? What's going on? What is it you do have? We'd probably sign some kind of NDA with you, exchange some documents, make sure that you have the right to exchange those documents. And then very early on, we'd want to have a conversation with your GP, because, the GP is the power in the room, a lot of these, the decision maker that needs to be in on this. You can come to us and say, oh, I want to get out, but if your documents say that the GP decides that, then we really need to have a conversation with them as well. So it's very early on, we need to have that kind of tripartite conversation. Once we've had a look through it and understand what you own and understand like who you are, who the GP are, it's incredibly important, like the track record and reputation of a sponsor. We can go ahead and formulate a plan. We will have some ideas on where this might fit. Like, we speak to a lot of different types of investors, and, no two deals are going to suit everyone. So initially we'll have a think about that. And I think initially what we do as well is to understand if this is really something we can place, because we don't want to drag people through a process if there's something we don't think we will have the ability to place for them. So very early on, we try to learn as much about what you have, try to understand how it would fit with investor demand, and try to understand what kind of pricing you might be able to get on that. We don't do valuation, like we leave that to the investors. We obviously could, but what we focus in on is trying to find a valuation range, trying to understand what something like this might need to be offered at in order to find demand. I think that's the key for us. I mean, and I guess another thing to say is that when we work with people, we work on a success basis, and we get paid, percentage commissions. So, if nothing happens, you don't owe us anything. On the flip side, the more money you make, the more money we make. So we're aligned on that area. And in that respect, our ambition is to get the best price possible. So valuation range is trying to find a starting point and then go out and try to maximize that demand. So in that second stage, we would go out and start marketing. Once we feel comfortable that this is something we can place and that, there's substance to it and it's something that will fit our base, we can go out and we can start the marketing process. Hopefully ending at some form of auction process. Like, some deals are very niche, some are more mass market. We've seen incredibly niche deals. We've seen very, very bog standard ones, and the amount of demand you're going to have varies from deal to deal. But the idea is to get you as much exposure as we can. So that's relative to the process. And then what I would also say is that my experience with syndications is shorter than Jackson's, but what I've found out that no two deals are the same. This isn't a stock of IBM. And this is certainly not a fund share in Blackstone's fund number 13. Once you deal with these smaller deals, there are idiosyncrasies. There are, things you got to catch. Like, there is an incredible amount of, supporting documentation. So the process will not look the same for every deal we do. It will be slightly different. And that's just something that we deal with and we manage with the client.
Just to follow up, Simen, what are some of the things that affect a liquidity of, let's say, an equity position?
Well, I mean, ultimately, it comes down to demand, right? If you think about liquidity in a straight theoretical point of view, you're wondering about bid side liquidity, right? And the bid side liquidity comes down to how many investors are in the market and how big they are. That's ultimately it. And then it's almost like a match. We're more of a matching service than anything else. So if you have something that is a very standardized size, let's say Jackson said, if we have a position of somewhere between $5 to $15 million, there's a lot of people that would look at that. We deal with institutional investors. A lot of them would look at a size like that. So that gets us into a broader spectrum. If you come to us with $500,000, that narrows the spectrum down. If you there are all these different factors that come down to your position specifically, but then there also is a business cycle, I'd say, and preference element to this, right? Different points of the cycle, different investor preferences will shift immensely. In just a matter of a month or even a week, you can have an incredible shift in appetite. I bet you there were people in January and February 2020 who were dying to get their hands on an office, who in April and May felt very different about office investments. So demand for that particular position will change immensely, not just from what it looks like itself, but the environment it sits in. So yeah.
Right. And I presume that the changes in demand will also likely affect the valuation of this equity position in the secondary markets as well, right? Because if I have $1 million and I'm looking to, let's say, get out, what are the am I going to get out at a discount, or am I going to get out at the full amount that I let's say invested? Like, how would it work, or what are some of the factors that would affect the valuation of this equity interest?
Well, it's a great question, right? Maybe I'll just start off a little bit. I'll hand it to you, Jackson. Because I think one key thing is, like, to get your money back means retrieving your basis. Now, the valuation of the underlying real estate might have moved massively over those years, right? You might have put 100,000 in. Like, if you did a deal in the mid 90s, you put 100,000 in, it might be worth 2 million now. Just getting your basis back is actually a massive loss to you, So it ultimately links back to the real estate, and then trying to understand within that specific asset class and market and these kind of things, what it is you actually own. And Jackson, I'll hand it to you.
Yeah, it also goes back to the documentation of the deal, right? Like, if there's certain rights that the limited partner has, and therefore the more rights the limited partner has in the deal, the more value that the position will be worth. If it's a very restrictive deal, and this limited partnership position basically just has to sit there and take whatever the GP hands out, well, then it's going to be worth less. And that doesn't just go to the economic rights, but the rights to affect major decisions, the rights to the mechanisms that are contemplated inside those partnership documents will affect the valuation of each position very differently, right? If there's basically a mechanism inside of a partnership position that makes that limited partnership position very rigid, then it's going to be worth less than one that has more flexibility and has more rights to affect change at the asset level or at the operational level. So, and the devil's in the details. I mean, you have to read through all of these partnership agreements, and we do that when we need to, but mostly it comes speaking with the LP and speaking with the GP, double checking the documents. We're not lawyers, and just making sure that we understand what these different mechanisms inside this deal are, and you gotta be straightforward with that. They have to be straightforward to us, and then to the investor, we have to be straightforward to them. Like, these are the opportunities of this position, and these are the pitfalls of this position. You need to make a decision whether you're comfortable with it, right? And so the valuation, something could be worth zero to somebody else, and could be worth $1 million to somebody else who's comfortable with that particular mechanism of that deal.
But I think that's such a good point, right? Because inherently, valuations is a very theoretical exercise, and what we're after isn't a theoretical value. We're after an executable price, right? So it links back more to demand, as Jackson says. Like, are there things that make it more and less attractive to another investor, rather than necessarily like, is there a model that better values this stake?
Loving it, man. You guys are going deep, trying to figure out where to hop in here. But I mean, we could definitely keep going, and we will definitely maximize our time here. We had a few questions come in from the audience, and then Mo and Shah, if you guys want to keep zoning in on this. Again, our attendees right now, feel free to ask questions. This is technically the Q&A portion We'll start off, and then Simen and Jackson, we got two. I'll let you guys decide who answers which one. One from Wade, and that is, can you give an example of a deal that you're working on right now that you're very excited about? And then Allison wants to know, if you had to guess, what are the top 3 objectives that you face when working with clients? Or did I say objectives? Objections.
Objections. Why don't we start there? I mean, Jackson, do you have any objections when working with clients?
I mean, look, the objections usually come from the general partner. Sometimes there's so there's that limited partner level and there's general partner level, and arguably there's the investor partner level, but let's not address the investor partner level because, the buyer, the investor, the new buyer investor, like we were referring to, has the box that they want to play in, and not everything fits into that box. And those are their objections, right? It doesn't fit into what we're trying to do or what we like to buy. And we had one of those conversations today. But on the limited partnership, it's often price, right? Like limited partners, and we try to get the best price possible, but limited partners often will say, the latest NAV is my position's worth $10 million because that's what the NAV is. And you got to look at them and say, yeah, but you've refinanced 3 times, you've tripled your money. And by the way, like anybody getting into this doesn't know the general partner the way you did, or they have to have a different comfort. This can be a different comfort level, that general partner, and with the deal. And there's no liquidity to these things except for us, right? You can't just go sell it like you can an asset. So you can't value you do an asset. There's always going to be some discount, either large or small, for illiquidity, lack of marketability, so on and so forth, right? And for lack of control. So that's the biggest objection is, and it takes time, and we'll tell them we think it will trade for a range of this to this. And slowly over time, we get bids back and they see that we're pretty much on the ball, right? Pretty much on the money when we told them this is kind of where we think things will come in for. Some people want 100%, they walk away, and they're gonna sit there and wait for inflation to take them to that 100%, which will no longer be 100%. And some of them, like I did in my own deals, came to Jesus, as this saying goes, and goes, okay, all right, I see I can get 80 cents on the dollar. That's a great deal. I'm out, right? The biggest objections, I guess, from the GP is, who's this new person coming in? I need to get comfortable with them. I want to make sure they're not going to be an activist investor. I want to make sure they're sophisticated and they're not going to call me asking about every line item in the quarterly financial statements I send them, and that I'm not going to have a problem on my hands, basically. That I'm not trading one problem with an LP who wants out for another problem, which is an LP who won't let me sleep at night. So I'd say those are probably the 2 main objections that we face. I don't remember the first question.
No worries. Yeah, the other one was, can you guys give an example of a deal that you're working on right now that you're really excited about?
Yeah, I mean,
So
I would just like preface it, like because we're in the securities world, we're not soliciting investments here. We're not trying to sell anything. This is more for informational purposes. But yeah, there are tons of deals we're excited about. Maybe Jackson, you can say something broadly about what we're working on at the moment.
Yeah, so a third, besides the limited partnership recapitalizations, the general partnership recapitalizations, those are 2 of our legs of business. There's a third leg of business, which is raising new equity. And it's the recapitalizations that really distinguish us from the other intermediaries out there raising new equity. However, because of the secondary positions that we deal with, we get introduced to a lot of very interesting concepts, a lot of very interesting people doing out of the box things. We also do standard straight, multifamily value add opportunities, things like that. Simen and I get excited about different deals. Simen gets excited about one deal. I'm like, it's cool. And I get excited about some deals, and Simon's like, I guess it's cool. If you like it, we'll do it, right? The deal I'm excited about right now is is a new resort in the Caribbean. It's a new concept. It's an incredibly creative concept. I have the background in casinos from my time doing the Cosmopolitan Resort and Casino in Las Vegas, being on the development team of that. So I learned a lot about how these properties just print money with conventions and events and so on and so on. I mean, just obscene amounts of money. This guy has a really creative concept. I see it because I've seen it in the casino industry, and he's putting something together. I can't go into too much detail about it because I don't want to, for multiple reasons, but I don't want to run afoul of securities law. But it's out of the mold, and sometimes things come out of the mold, and you're like, it's out of the mold because it's insane and it's never going to work. This is out of the mold, and I think it'll work. I think it's fantastic. I think he's really understood a niche that is vast in the conventional world, and if we manage to put the money together for him and he expands his business, I'm sure one day he's going to go public, and it's going to be like a fantastic success story. So that's what I'm excited. Yeah.
No, look, I mean, for me, it's more broader than that. I think to see the market come back to life in the way it has in the start of January has just been insane. The first 3 weeks of this year has been like drinking from a fire hose. So that excites me. Deal flow, number of great deals in there. I love the niche that we're in. We get to see so many interesting projects at interesting stages, right? We're not just out there primary funding. There's some interesting creative stuff we get to be part of as well. So yeah, no, more generally excited about this year. Hope there's an effective vaccine and that we can get back on track in this world. But like, there was a bit of a roar at the start of the year, and that's always great to get back to. So yeah, excited about where the market is headed.
Good to hear. That's exciting to hear, and yeah, you can hear the passion in both of your voices, and especially Jackson. I mean, I'm going to keep that one on my radar now too, and kind of be like, yeah, you guys heard it here first, right? Next Level Webinars talking about this deal. So yeah, I mean, we got a few other questions coming through here, but I know Mo and Shah, you guys have some follow up as well. So we'll give it to you, and we got about 5 minutes left to go. So have at it.
Absolutely. So Jackson and Simen, what's the minimum size of an equity position that you guys would be able to, work with?
Well, so we tend to focus on deals or ticket sizes that are bigger than $500,000. That I would. Can you hear me, Jackson?
Yes. Sorry.
Yeah. No. Yeah, $500,000 and higher, and obviously limited by the fact that we stay within the middle market. I'd say there are a number of institutions we know that look at smaller stuff as well. We're not just going to turn that away at the door. I mean, a lot of the times it's just directing you in a different direction. But for us to get involved in, like, when you're doing a sort of a high touch service of working with someone and marketing, there needs to be a certain scale to it. And we don't want to overcharge what we do. If we get down to smaller deals, the percentages just look bad, and it's not really what we're there for. And it's not really value to the client either. So we draw a line at $500,000, and if someone comes in the door and has something smaller, I'm sure we can find somewhere to direct you. There are funds that buy these things directly from people. But that's where we step into slightly larger blocks. We know that there's an incredible forest out there of crowd-funded, LP positions and things like that, like 10K, 20K, 50K. I'd love to be able to do something about that one day and try to introduce liquidity to that market. I know there's some people trying to do that, but it's not something we've been able to do so far.
Yeah, maybe I should explain. Maybe I should explain why that is, right? Because what's important for everybody to know is that, Simen is currently, and I will be soon, registered reps of a broker dealer out of New York City. Since 1946, the Supreme Court of the United States has said if you're a passive investor in real estate, you own a security, not a piece of real estate. you own a security in real estate. So for that reason, trading these things is restricted, and it's restricted in such a manner that you have to be registered in order to do that. And that's why Simen got licensed and hangs his license with our broker dealer. And, you know, because of that, and the KYC, the know your client, and the anti-money laundering and all of these things, there's a certain amount of money that we have to spend in order to onboard positions and people. And therefore, at a certain amount of position, it no longer makes sense because it just costs too much money to do. So, yeah, I think in order to bring liquidity to those really small positions in the market, you'd have to really basically set yourself up only for that, right? You'd have to consume large portions of that market in order for it to make sense and really turn over a lot of volume. And you know, it's just not how we're set up. So we're not gonna tackle that now. Maybe it's sometime in the future, but not right now.
Cool. One more question. Mo or Shah, I'll leave it up to you guys.
Yeah, I'd like to ask a question. You guys had mentioned earlier about investor preferences and how preferences can change. And I'm kind of curious. Do you see the investor preference? How much does that align with the middle market that you usually see? So how much is the alignment from maybe like the smaller retail investor who maybe invests as an LP at maybe 50,000 or 100,000 versus an LP investor that invests at $500,000 or more? Do you typically see that they have the same investor preferences and risk appetite?
Well, I mean, I think they invest in very different ways, right? Once you become a bigger investor in your own right with ticket sizes and these kind of things, you start to discern more individual deals. You have more availability of deal flow. You become more picky, right? At least I've never dealt with the retail spectrum of this, but from what I understand, smaller ticket size investors usually tie themselves to a platform, i.e. maybe a cadre or maybe a GP that they know well, and they stick to that GP. So it's more on a kind of sponsor basis. While as investors get bigger, they kind of just more decide that, this quarter we're going to really focus in on getting some multifamily in the Sun Belt, and let's find a great sponsor that does that. Let's evaluate 5 of them, find the best one. What have they got cooking right now? But as an individual investor, like doing all that due diligence work is incredibly hard. So you're more relying on people to do it for you. So that's why, platforms like Cadre, like bigger funds, REITs, these kind of things are great for smaller investors. And this is obviously not a recommendation. People should ask their investment advisor what they think they should invest in. But that seems to me the way things are moving. It's really hard for, me as a person as well. Like I do this job, but then for my own personal money, if I were to sit down after I'm done in the office and read, more due diligence documentations and try to find the best GP sponsor in the Midwest to do an office building, it takes a lot of time. So that's why people hire professionals to do it. So I think that's the biggest difference, is that once investors become bigger and they become sort of your pseudo institutions, their single family office, or they're part of a multifamily office or something like that, they become more sophisticated in the stuff they look at. Yeah,
that's true. And I've also seen situations where a deep-pocketed LP will actually come in and actually dictate the terms of the split too. They may not like the 65-35 split, and they'll actually dictate that they think it should be more of a 70-30 type split. And I've actually seen that take place because I've seen the documents actually get updated, and I was curious as to why that happened. And I asked one time, and I was told, well, one of the big LPs didn't like the split, so it actually helped all the other LPs.
Yeah, absolutely. Once with big checks comes more power, and something that Jackson alluded to earlier is that there is almost this muddling of the line between the GP and the LP position with like a pseudo GP LP position, which is an LP position with major decisions or something like that, where you're sitting in the sidecar, like where you have some kind of preferential position, or you have more rights than others. So definitely as you get bigger, you get more power.
Yeah. Yeah. Thank you.
No worries.
Well said. Well said. Thank you. Thank you, Jackson and Simen, for investing your time with us here today. Before we continue on right now, what is the best way for anyone tuned in or listening to follow up and get in touch with you guys and ask any other questions?
Absolutely. Look, we have a website, syndicatecapital.com. On the website, you find our phone numbers. There's a contact form, or just reach out to us over LinkedIn. We're both on there. Send us a message. We're always happy to chat and get in touch with us.
All right. Well, ladies and gentlemen, thank you once again for investing your time with us here today at this next level webinar, Achieving Liquidity from Illiquidity.